Good morning, wherever you are. This is Tchaikovsky, and this is Accounting 202A. We are going through how do we account for call options. So let's go through and do this today. So we've got right over here, exercise 17-27. This is not my problem. Rather, this is the problem of Wiley. Therefore, you're not seeing any kind of copyright notices on this whatsoever. This will be an unlisted video for your benefit. So the first thing you have to go through and do here is we're being asked to go through and to prepare some different journal entries for a call option. What exactly is an option? Well, we are paying money for the right to purchase stock at a certain point in time in the future. Why do people use options? Because it gives us the benefit of an upside. Meaning that we can buy the stock at a certain fixed price. Excuse me. It gives us the benefit of an upside without actually having to physically pay for all of the shares up front. So we're essentially just buying this option. So the first thing is that these options do have value, and we're going to break this down into two separate parts. One is going to be, we're going to call this the time value. The other part is going to be the intrinsic value. What exactly is the time value? Well, when we buy an option, say for this one right here, the option will ultimately expire. Right here, I'm buying this on August 15th, and the option expires on January 31st. So right here, we've got this option price here for $360. This is what we're going to call the time value, meaning that over time, the value of this option decreases, and it will ultimately decrease down to zero. And again, this is the time value of the option is really just kind of the nominal value, meaning what we paid for it and how it decreases over time. Right over here, the other side of this, though, is the market price. And what we're going to see here is that if we own the option, yet we do not exercise it, what's going to be happening is that we're going to record something here for the intrinsic value. Or you could say, what is the inherent or the underlying value of that option? So we're going to break this option down into two different parts. One will just be the time value of the option, and then over here, the intrinsic value. If we bought the option price here at 40, and if the market price of the share was, say, like $20 for each of these, the time value of the option would go to zero pretty quickly, and we would never record anything over here. It's just when we have a situation where the option value is increasing over time in terms of its inherent value, that's when we're going to see a difference. So let's go through and do this. So our first thing that we're being asked to do is that on August 15th, we are investing in the call option. So here we're going to have 8/15/16, and we're going to debit call option, and we're going to credit cash. For $360 and $360. Okay. So my time value of the call option as of 8/15/16 is $360. Okay. And we'll call this here to record purchase in a call option for Counting Crows Inc. Okay. So the next thing we're going to go do here is we now get to our quarterly report. That's going to be as of September 30th, 2016. So I get over here to my quarterly report, and I'm preparing my financial statements. So my option here has two different values. On September 30th, the market price of my shares is now 48. Well, my option price, meaning what I can purchase it for, is at 40. So the value or the intrinsic value of this option is increased by 8. At the same time, the time value of the option has gone from 360 down to 180. So I need to do two things. I need to adjust for the time value of that option. And I also need to adjust the intrinsic value for the option. So the first thing I'll do here is to adjust for the time value of the option. I need my ending balance in this one right here as of 9/30/16 to be 180. So what do I do to make this balance here 180? What we are going to do is I'm going to need a credit for 180. And so what I'm going to call this over here is on 9/30/16. I'm going to call this, okay, so we're going to call this unrealized holding gain loss income on call option. And I'm going to credit the call option here for 180, 180, and we're going to call this to adjust the time value of the call option. And note here, you do not have to use two separate T accounts. What we're calling the total value of the option here is the sum of these two parts. So I've done my first part for this on September 30th, 2016. The next thing I need to do is to adjust for the intrinsic value. So for the intrinsic value, right, what this is right here is that, well, so for my intrinsic value, I have the option to purchase 400 shares. So the value of this option is going to be $48 per share. Okay, on 9/30/16, my cost per share for the option is going to be 40. So my intrinsic value per share is going to be 8. So what I do now is I say, okay, if my intrinsic value is $8 per share, how many shares do I have the option to purchase? Well, right here, I have the option to purchase 400 shares at the option price of 40, which is the cost per share. So here I'm going to then take hold on, make this a steak sauce. So my option shares here are 400. When I multiply C1 times B1 or F1, this is going to be here, my intrinsic value. And let's make these nice dollar signs here. There we go. Perfect. Okay. So this is going to be my intrinsic value at 9/30/16. So we can come up here. My intrinsic value as of 9/30/16 is going to be 3,200. So the next thing I need to go through and do once I have this 3,200 is I need to record the journal entry. So I got 9/30/16. I'm going to call this call option intrinsic value. Let me just change something real quick here. This is going to be call option time value. And we're going to do this right here. I always feel like it's Bob Ross painting. I know we're going to make this like a little bit green right here. And this is, we're going to just use a little blue and just bring out this T account just a little bit more. So right over here, I've got call option intrinsic value. And then I'm going to have over here an unrealized holding gain, loss, income on call option. And this is going to be for the 3,200. Again, why are we calling this an unrealized gain? Because as of right now, this option does have value. I could turn around today on September 30th and I could have exercised it for $48 per share. Therefore, I want to, just like a normal investment, I want to go through and recognize an increase in that value. Okay, so that is where we are as of September 30th, 2016. And let's go back up here and look at our next date. So our next date here is December 31st, 2016. And this has now, but our option price has gone down to 46. And the time value of the option is now at 65. So what I'm going to do over here is my 12/31/16 option, or the value for this time value of this option, it now needs to be 65 right over here. So if my time value needs to be 65, my adjustment is going to be 115. So my adjust as of 12/31/16 is going to be 65. So I'm going to go kind of do the same thing right here for part C. So for part C, I'm going to have 12/31/16, kind of go through and here do the same form of journal entry, except now we're at 115. Oh. And this is going to be to the adjust the time value of the call option. And again, notice here, the value of my option is 65. So as of December 31st, 2016, it's 65. So I'm putting that value right here, started at 180. What do I need to get from 180 to 65? I need 115. So that's our first part. But over here though, this is now at the intrinsic value is no longer $48 per share. It's rather $46 per share. So what we need to figure out is over here on 12/31/16, what should the intrinsic value be? And then we need to make the appropriate adjustment. So over here, this is on value of the option 9/30/16. And let's call this now 12/31/16 intrinsic value. Okay, so over here, we've got, call this A2, $46 per share. So my intrinsic value per share is going to be $6. And then over here, my option shares, or D1, so I've got here C2 times D1 equals F2. So my intrinsic value as of 12/31/16 dropped. So over here, this is where I just computed this over here to be $2,400. So again, this reflects that price drop in the per share amount. So if I go over here and look at my call option, I say, okay, it was at 3,200. It now needs to be at 2,400. So my adjustment for this one particular item is going to be what? Well, my adjustment here is going to be 800. That's how I get from 3,200 down to 2,400. Okay, so I'm going to go over here, and my next part of my journal entry will be 12/31/16. I'm going to have an unrealized holding gain loss on the income on the call option. I'm just grouping those together here with this account. Debit here for 800, and then I'm going to credit the call option intrinsic value here for 800, and this is going to be to record change in intrinsic value. Okay, so we've gone here and we've recorded what's happened here at September 30th and also as of December 31st, 2016. One other thing just to kind of note is that if the share price ever dropped below 40, we would never be showing this here as a negative number. We don't have a risk if the option price goes down. Rather, we would just not exercise it. So with the intrinsic value, we're only going to be recording gains. So those are our journal entries here. And if you say to yourself, well, Tchaikovsky, like, look, dude, this went from 48 to 46. That's $2 per share times 400. That's 800. Yeah, that's all I need to do. Yeah, that is all you need to do. The reason why I go through and do this again, this is like, you know, instead of it's painting with Bob Ross, it's T accounts with Tchaikovsky. And it's like 4:35 in the morning, and I'm pissed off because I put basically students that were not in my class as a priority over my awesome fall 2018 intermediate accounting section. Yeah, so I'm pissed. But hey, I'm not pissed at you guys. You guys are cool. Everybody here is cool. But yeah, you can do it either way. I'm just explaining it out this way because that's just the way I am. So over explanations. All right, so over here we now get down to letter D. And are we almost done with this problem? Sure. So what I want to do first, because now I'm settling the call option. So here when I go through and I settle the call option, the first thing I need to do is I need to record the time value down to the appropriate amount. It tells me here that the time value of this option is now $30 per share as of 1/11/15, or what is it, 1/15/17. I knew my numerically dyslexic at 4:35 in the morning works well. Okay, so right over here, I've got this value here to be at 30. So the first thing I need to do is I'm going to need to make an adjustment at 1/15/17, and this is, we're just kind of prepping this thing right over here for sale, because now we're going to be settling it. So letter D, my first one is going to be 1/15/17, and I'm going to go over here and kind of do the same entry. Unrealized holding gain loss on the income, loss or income on call option. And then here, debit for 35, credit for 35 to adjust the time value of the call option. Okay. So right over here, I now adjusted this to 30. So the next part of this is, now that I've done this, now that I've adjusted this for the time value here, I'm now exercising it, or I'm settling it. So what I need to do is I need to take this option off of my books. So the way this works is that when I settle this call option, generally what can happen is that I can be paid. I could pay $40 per share. So let's just kind of think about this for the cash side. On 1/15/17, if I look at this just from a cash standpoint, right? If I say okay, I've got here cash. So if I would have to pay cash to exercise, this will be 400 shares. And if I have my share price or my option price is $40 per share, cost for a total of 16,000. Now, if I had to purchase these and turn around and sell them, then over here, I would be selling these for $47 per share or my exercise price. So over here, I've got a total of 18,800. So if I bought these shares and then turn around and resold them, my profit on this would be 2,800. And usually what will happen in the finance world is that they'll just say, okay, when you're going through and doing this, we're just going to go ahead, we're just going to give you the net amount. We're going to essentially say that, all right, we'll just assume that you're exercising and the broker will pay you the difference. So what we're going to do here for this entry is we know that we're going to be getting cash of 2,800. So we're going to be debiting cash for 2,800. And the other things that I need to do is I need to take, and so let's, again, when I'm settling this option here, the option is basically settling at $47 per share. So at 400 shares, I would normally be making 18,800. My cost of the option, though, is I still have to buy the shares at $40 per for 16,000. So my net cash proceeds are going to be the difference between these two right here. So my difference here, G1 minus G2 equals G3, is going to be 2,800. So I'm going to put this cash over here at 2,800. Now, the next thing I need to do is I need to get rid of all of these things off my books. So we'll call this a sale adjust on 1/15/17, or we'll call this settle adjustment. And what I need to do here is I need to get rid of these remaining amounts. And because once I settle the call option will have a 0 value on my books. So here I'm going to have call option time value for 30. The second thing I'm also need to get rid of is this call option intrinsic value. And the reason why is because I am going through and settling the option. And as I go through here and I settle this option, this amount here needs to be 0. So what I'm going to do here is I'm going to credit this here for 2,400. Intrinsic. Over here, I've got call option intrinsic value for 2,400. And then, so my last one here, I've got a net credit balance of 370. We're going to call this a gain or loss on the call option. So let's record settlement of call option. So this is kind of what I'm doing as my option increases or decreases in value. I'm making the appropriate adjustments. And then ultimately here, I am going through and then basically making, I need to make these amounts zero because this option, this option is no longer on my books. So there we go. And if you just wanted to kind of check your work, the stock price increased by about right over here. It went from 46 to 47 bucks. At 400 shares, it's basically $1 per share. So if I look at my realized gain during that last period of time, it's really 400. And why are we only showing 370 here? Because I had to get rid of my remaining part of my call option, or what it was kept for on my books. So that is a very basic problem and explanation of call options. I want to thank you for joining me here today. As this is not a copyrighted broadcast because I don't own the question, but hopefully you found this helpful. Please do not forget to like and subscribe secretly to my unliked video, my my unlisted videos, and I will see you for the next one. Thank you.